All right. All right. Welcome back, everyone, to another episode of Chart Talk. We're going to change things up a little bit this week. Typically, we go over the major markets first, major sectors, and then top ideas. Going to keep you guys on your toes. And we're going to start with some key stocks first, and then we'll pivot back to the indexes and the sector. So, a couple of names we've been keeping a close eye on. First has been this Roku, major weekly base here. And it just reported earnings last week and had hold on a second. There we go. So we had this major base going back, a couple of years now, was not able to get above this, 110 level, going back 2021, 2022, 23, 24, multiple years, cannot get above this massive base. And the longer these bases set up, the bigger or more explosive the move tends to follow. And we started to see that with the earnings report last week. So it's been battling with the 100 level, it's battling with the 107 level, and we were trying it back in October. And earnings, big pop on earnings, 10%, nearly 20% day. Again, it gave some of it back, but now it's starting to give you those signals of this base is now ready to start transitioning into a breakout stage. So it's just waiting, for that little pullback, waiting for a little bit more defined setup through these areas. So definitely want to keep a close eye on this Roku. Next, we have this Palantir. We had this blue sky breakout we were talking about last week. Let me zoom in a little bit so it's a little easier to see. And, it broke out running up into earnings. We have earnings coming up, should be after the close shortly. And it's already up a little bit pre-market from its earnings. So again, nice breakout so far. Great to see it up a little bit higher. Super strong chart. Again, if you're already in this name, it's had a phenomenal year. Great to be in it. Tougher if you're obviously buying it after earnings today, but if you're already in it, this 190 stop is, a very tight area. If you're in it from, much lower, this like 167 really has been the spot. So if you've been in it, stick with it. If you're not in it just yet, you got to wait for the more of a pattern to develop after that 190 breakout. Next, Tesla, we've been in for quite some time, from this 360, base break. We saw the retest at all-time highs beginning of October. Beginning of November, it's back at those highs. Again, I'm going to zoom out a little bit. Again, we can see all-time highs, back in end of 2024, retested in October, and now that resistance level is becoming a little bit weaker as it keeps getting up into this area. So eventually we should see a break through this 470. And given the range of this current flag, 400 to 70, we could safely assume or expect about a $70 breakout, which would send this to about 540. This would be the short-term measured move once we get a nice break and close above this 470. So maybe it goes tomorrow, maybe it takes another few weeks, but when we can get a significant close above this 470, expect to move to that 550 area, just in the short term. Again, much bigger macro pattern, but just a shorter term momentum trade here. That is the target there. So for me, I had two trades last week, got out of this bud, just kind of a little bit more of a slow mover. Again, we were looking at consumer staples the last 2 weeks when we were seeing some weakness in the markets. The markets have snapped back. We've seen consumer discretionaries in tech and a lot of the leaders come back into play, and consumer staples have kind of gotten taken to the woodshed. So we made a little bit of money here in Budweiser, nothing to really lose sleep over, a couple of bucks on very tight risk. So moved on from that one. Not the biggest deal, just little putting some money on the table. This REITs today, again, that was my focus after the Budweiser trade, was looking at the REITs. We had the rate cut. We had REITs getting smoked into the announcement and then starting to base out at support. So took a tight risk trade here, and unfortunately, I got shooken out this morning. Literally marked the low kind of to the penny, and it's kind of snapped right back. So it shook me out, came right back. not really the types of action I want to see at support. You kind of want to see this action when names come into support. You want to see it, looking pretty bleak coming into it, and you want it very quickly up and away from support. You don't really want it hanging out here for a couple days. And again, technically, maybe I'm the shakeout and maybe tomorrow it pushes through 90 and it gets that run up to 92. But, shook me out. It is what it is. I'll take the 1% loss, not lose sleep over that. So those are just kind of the two trades in the last week or so that I've been focusing on. Again, still in this Tesla, no changes from the 360 entry, just still letting that one work. So moving on to a couple more individual names. We have this Walmart. Again, a lot of the Dow 30 names have been very strong lately. We can see this overall channel that Walmart has been in. Abby did a great job last week when she was buying this Walmart and kicking into this, 110 area. So again, taking these ranges we've been seeing even in the indexes and, selling into resistance and buying back into support. And that has worked for many months now. And sometimes, the simple approach is best. So we're seeing Walmart pulling back into support. Really would like to see a shakeout down through this 100. Again, it's been holding, pretty much since September. But as it pushes out, to the upside, we kind of need that little, shakeout to the downside, just like with my, REIT trade. It had to push just enough to shake me out before turning. This Walmart, before it's really ready to bounce, back up towards this 110 again, would expect or would like to see a break of this 100, come into this, 98, 99 area and then turn back up. So keeping this one on the radar. Again, SoFi, one of Tom Ramsey's, top ideas from a little while ago. Again, our favorite setups with these recent IPOs. When I mean recent, it's an IPO from a few years ago, not a week or two ago. It's been out for a couple of years. But we want to see these breakouts through those initial IPO run up highs. So back in 21, ran up to 30, then got smoked, lost 90% of its value. It's clawed its way all the way back. And now it's finally pushing through these highs. And this is when you really want to find those setups and just give it first the proper room. These are really trades where you don't want to be too perfect with the entry and an exit. These things really need time. So if you're looking at SoFi, you're looking for an entry, the real out is verse 25, and is just trying to find a tight risk spot to get into it and just giving it the right room. And more importantly, the time it needs. Like this setup, when these things get through highs, you got to give them, 6 months to a year to really get going. It's not going to be, an overnight kind of very quick trade. We have AMD reporting earnings tomorrow. Again, we have some members that were in it from this 160 area and then caught that kind of AI news. And the key out right now is really versus this 200. You had the AI news, you had the big pop. Again, this area was the all-time high retest. Let me zoom out a little bit. So AMD is, kind of flagging out down here before that news, has the big AI news, gaps up basically to all-time highs, sells off to 200, and is now back to new all-time highs. So the path of least resistance seems to be higher in a lot of these semis. Semi sector has gone a little bit extended, but really for right now, anything above 200 AMD, totally normal price action. That's the real area. If this trade is going to fail and it's going to, start rolling over, that's really the spot where it's going to be confirmed that this trade is no longer, heading higher. Oscar was just a name from a week ago that a member was looking at to buy, into support in this trend line. Again, when names are getting into these support trend lines, you don't really want them to be hanging out there for too long. Just like my REIT example, it really shouldn't have been down there for the last couple of days. It should have, kind of came down there, bounced, and got quickly away from it very, as quick as possible. That's a great support buyback. Of course, is what you want to see. But when the name is hovering there for a couple of days, that's not the sign you want to see when it's a very clear area of support. So if this is a very clear trend line and it's hanging out here, more than likely it's heading lower. And this was a trade where it was like, this is an avoid, talking with this member, it was just wait for 24. Instead of trying to be perfect at support here at 19, just wait for this breakout. And by avoiding this trade, you avoided the 10% drop that really nothing, material has changed with the name. It just broke support and it's drifted lower. So that's where with these support buybacks, you got to, they got to come down quick and snap back and get out of there. Or this is kind of what you see. So Oscar, avoid, wait for that, 24 breakout down the line. Next, we have this BE, some members in them like Raheem, who had a great trade in this through this 45, had some other trades in it since then. But with earnings out of the way, now this is now the new key area of support in this trade. If he's still in it, or if you're watching this during this name, really 120 is the out. For now, path least resistance is higher. It's been breaking out. You can see it kind of getting a little more vertical in the moves it's been having, where it was a little bit slower here. Again, this is why we focus on buying these names through all-time highs. So you can see this BE for years could not get above 45. Has this run up, but all this time just chopping around. And this is often where new traders get really jammed up, is they try to buy this name when it's at 20 bucks. And they don't realize that it can spend half a decade doing nothing and just slowly grinding lower, where once it can clear those highs, you can see how quickly this name gets going. So this is a prime reason why when we look to trade individual names, I'm always trying to find the name when it's the most expensive. Again, it's not the easiest entries. Again, it always looks super easy after the fact. It looks like you just bought 45 and it went up 100 bucks. Again, this still is not the easiest trade to hold, but it's much easier to just wait for these all-time high breaks, like we're talking about Tesla before. Buying Tesla through all-time highs right now doesn't look like an easy trade. It looks like it's going to, drop 70 bucks. But these are where you get those much quicker moves, just like even SoFi. SoFi is right here. It's kind of messing around, but it hasn't sold off. It can't break, below 25. So if there's any key lesson from this, looking at this chart, as difficult as it may seem to buy through all-time highs, you typically get bailed out and you get much more upside than trying to buy the name when it's pulling into support or major support or looks cheap. It's going to be cheaper for years before it gets really expensive. So that's the key thing there. Moving on, we got this Zoom. Again, we've been talking about these big bases. Again, the Zoom has gotten crushed since COVID, but it has been basing out for the past couple of years. And we have a big base break through 120. We also have a pretty significant base break through this 90 area. So again, definitely need some time. Earnings coming up end of the month, but keep an eye on this Zoom when it can get above 90. For the members, again, I have alerts set for this, so you don't have to worry about it. You'll be reminded when that happens. Paramount was one of members' idea recently who's going through the program. And again, pretty crazy name many years ago. Had some hype when there was, I can't remember the individual's name. He's in jail now, but he was manipulating Paramount and Warner Brothers. They both had these crazy run-ups and the stock slowly died. So, this newer trader who is newer to the market was kind of expecting this kind of move to happen again. And that doesn't really happen. That's kind of a one-off thing. And the guy's in prison because of it. So you don't want to go to, jail over pumping a stock. So again, with what he was trying to do here was he was trying to like load the boat in this stock, expecting it to just go up a lot because he's in, or he has some insight into what Paramount Plus is doing. And pretty much the point of our conversation was just wait for it to break 20. If this thing's going to go to 40 bucks, or it's going to go to 60 bucks, or it's going to go to 100, it's going to have to get through 20 first. And it's much easier, just like with that BE example, to buy this name here at 20 than to buy it at 15, sit with it through 10, watch it drop 50% on you. And then when it gets back to 15, you're like, get me out of this thing. And then it goes to 20, it goes 30, it goes to 40, and you're stuck with, with no stock. So if you have this really crazy conviction on a name, instead of trying to chase it on the way down when there's nothing really going on with the name, just wait for the price action. When this thing's going to go, have alerts set, buy it when it's going to go, determine the risk at that point, much easier than waiting years for this thing to turn around and really get going. So again, last week, the big news was all the FAANG names. Again, hundreds of names were reporting, but the FAANG names were definitely the ones most in focus. Again, we have Apple was pretty much got bid up into the report, closed at all-time highs, and then even with the earnings beat, barely didn't even look like an earnings reaction type of move because it had already run up so much. There's only so much more of these names can go. Again, an individual kind of smaller cap name, sure, you can really gap it up and it's going to go. But Apple, one of the biggest companies in the world, it's a big, heavy train. It's not going to, be this very nimble stock that's going to, have a dramatic move on earnings. So expect this to be probably a short-term high for the most part. Again, expect, a flag to start to form. Again, name's super strong, so wouldn't expect a significant pull in, but could expect Apple to start to kind of flag out here in this range and then set up, just like when we try to draw it out. If this is all-time highs, we'll see a retest, maybe in December or maybe sooner. And then eventually, probably the new year, you have a more developed flag here, and then you get that breakout through 280. Just like in Tesla, we want to buy 470, buy 480. 2 years ago, you would not want to touch it. And recently, in October, wasn't a time to buy. So you need those patterns to develop. Another one of the FANG names, again, Meta, kind of had the gap down on earnings, 10% gap down. Really, the big thing there was that one time charge for their kind of tax bill they got smoked with. So expect when you have this key support that was holding all summer break, this is now a technical topping pattern. This is a stage three top. And now what we should start to see is a stage four breakdown, which is like what we're seeing in financial stocks. We're not really seeing them, in the tech space, but this is a very clear breakdown stage and even breaking the lower range of that breakdown stage. So, Facebook is definitely an avoid in the short term. Again, we're talking about financials. We've been talking about these stage four breakdowns and why we avoid them. Again, couldn't pay me to buy a financial stock right now just because how the sector is trading. Once it can break this stage, no problem. But for names like Meta right now, it's in a stage four breakdown. Again, we saw the same thing happen earlier in the year. It's actually somewhat funny that Meta and financials both had kind of similar breakdowns at the same time. But again, let this name pull in. There'll eventually be a buyback through 680, but Meta, big avoid. Amazon, another FANG name, big gap up on earnings, had an AI deal. Again, every stock right now is having these little gap ups from these AI deals. Eventually, that trade will get old, like we're seeing with Amazon. A little bit of a gap up wasn't this big, like AMD 20% plus gap up. So everyone's kind of milking the AI deal trade, just like during COVID, everyone milked their missing earnings because of COVID. So, everyone's kind of using that one trick pony right now until it doesn't work anymore. So Amazon's really not a tradable spot. If you're in it, great, hold it. Again, key out right now, way, way lower. This 210 really is the key out. If you're already in it, hold the winner. Path of least resistance is higher. So stick with that one. Google and Google, again, basically same chart. So I'm just going to go over Google. Again, another example of why we like to buy through the all-time high break. So this was back in August when Google's breaking out of all-time highs. Again, seems expensive, seems like it can't go higher, seems like it's the riskiest, and 80 points higher since then. If you bought through all-time highs, you set a stop below the prior pivot low, you get bailed out. So again, Google was closing at all-time highs going into earnings. Again, we saw from all the FANG names so far, the ones that gapped up, they were already at highs. They had these marginal gap ups, and we should expect these areas to act as, short-term resistance, and then expect, a nice little flag to form in Google, just like it did here. Flags out and then it goes. So, these patterns continue to repeat themselves. Just got to give Google a few weeks or so to settle out like it did, back in September and October, and maybe we see another breakout higher. Wrapping up the FANG names, we got Netflix. Netflix is a huge avoid. Again, Netflix and Meta, both big avoids. Amazon, Google, if you're in them, keep holding them. But why is Netflix an avoid? So, like Meta that had that gap down, big gap down on earnings, gaps down right at the key support area. This is key support all summer. Gaps down, it sells off under support. Everyone who's bought this stock since May is now underwater. So it's going to just add more pressure to push this name lower. And they're splitting their stock. So when do companies split their stock? When their stock's very expensive, after they've already gone on insane percentage moves. So let's look at Netflix, what it's done in the last, you know, couple of years. This name's gone up sevenfold from 2022. So when names go up in a significant amount and they get too expensive and the average investor can't afford one share of Netflix, it appears too expensive, they split the stock. And when you split a stock when it's expensive, it is good for the company because it brings in more average investors, but it makes the stock much more thick. If you've been trading for a long time, you remember when Apple before they ever split $300-$400 stock, it was the craziest stock to trade. Now Apple is, an old freight train when it's moving because it's so big. It's been split a couple of times. The share flow keeps increasing, and it just gets a little bit thicker to trade. So with this split, it's going to be a 10 for 1. So on, you know, the 17th, Netflix will be $100 stock again. Nothing changes material with the company, but it's a sell the news event. If you're buying Netflix because it's cheaper when really the only difference is the amount of shares, those people aren't educated investors. They don't understand what a stock split is. They don't understand it's like going to the bank with a $100 bill and getting 10 tens. Nothing has changed about the company. But what tends to happen is it brings that crowd in and the smarter crowd tries to leave. And we saw this with, Tesla and Apple did this a few years ago. And let me see if I can pull it up really quick. And both of those names had gone on extreme run-ups at that time, and the stock sold off dramatically after the split. There was a pretty famous, here we go. So we had this split here. This is going back to 2021. Just give me a moment. All right, so you have Tesla go again, sevenfold increase, split adjusted, low is 25, runs up to 175, split adjusted. It's most expensive it's ever been at that time. They do a split, 5 for 1. Stock drops, 30% in a week. Apple also, they both were kind of doing the same thing at the time. Again, Apple's run up wasn't as insane as Tesla's, but they both were kind of trading somewhat in tandem. Give me a moment. Here we go. So Tesla as well, not a sevenfold increase, but up almost 300% from this low here to this run up here. And to the day, or I had one more day until it sold off, 140 to about $100, 30% plus pulling once the split went into effect. Again, it's the people chasing the end of the move, and then there's no one left to buy. The dumb money crowd is buying that split. There's no one left to come into that trade, and then the only thing that's left is for it to pull back in. So Netflix, with that split coming up in about 2 weeks, if you're already in it, you're up a bunch, just expect some, short-term volatility. If you're looking to buy Netflix, please, just wait till the split and wait a month. And then, if this thing pulls back into the equivalent of which will be $80 a share, different story. But you never want to chase a split. Anytime you see a stock splitting, run for the hills. Moving on to a couple other names that some members are looking at. Brandon was looking at this SFY. Again, I definitely see the flag he's looking at. My only hesitation has been the fact that financial stocks have been somewhat weak. So again, strong name in a weak sector, looks great, earnings are out of the way, could break this. Again, if financial names can break out of that breakdown stage, even better, but would just proceed with a little bit of caution here because if the entire sector is getting pulled down, the strongest stocks get pulled down with it. They just get pulled down last. So just got to be careful there and just be aware of where the sectors are at. Next, we have this TEM. Again, like we looked at this Walmart, nice channel here, getting really tight at support. We got earnings coming up tomorrow. Again, it's definitely going to be the catalyst here, just getting kind of pretty tight in this area. Again, it's going to have to go one of two ways. This typically happens going into earnings. Everyone's kind of waiting for what the reaction is going to be. Either get that big pop higher and this channel continues, you get the gap down lower, and the trend changes. So got to wait till earnings on this one. If you're already in it and you haven't taken profits, you got to really figure out where your price point's at. If you're up more than 20% the name, you're probably okay holding it. But if this thing does gap down, it's a pretty volatile name. So I would not, would be prepared for some big swings in this name, good or bad. Next, we have this AER. I believe Kevin was keeping a close eye on this. Again, after a name gaps up on earnings, you want to see a flag form, super tight consolidation here. Very key entry through this 132, key stop 129, 1% risk. Again, it's in this financial space. Talking about financial stocks being a little bit weak lately. This name clearly doesn't care. So, this one, between the two financial names, SFY and AER, if I had to be in either one, gun to head, I would take this AER through 132, blue sky breakout through all-time highs, then the other flag, an SYF. Next, we have this court has earnings tomorrow. Again, we've been talking about these bases. You can see base has been forming for quite some time. Again, super tight here. But again, earnings is tomorrow. So either it completely takes this level out if it gaps up. If it gaps down, who cares? But can keep this on the radar for a potential opening range breakout through this 75, 76 area. Next, we have GTLB. And we got this nice base forming through this 52 area. Again, earnings not for a while. And we can see has not been able to get above this 52 for pretty much the entire year. So definitely want to keep a close eye on this one for that break of the space. A few other names. We got this snow at all-time highs. If you're already in it, great. Stick with it. Again, key stop right now, short-term pivot is this 260. Much bigger pivot, much lower down this 230. So just some key spots if you're in it and unsure what to do. That's really the key out right now. Key short-term out at 260. One to keep on the radar is this eBay. Again, we're talking about names that are at all-time highs. Talking about names that get back to the retest where it acts as resistance, gets right back there, goes into earnings, gaps down, fills the gap. Gaps tend to get filled. So we have this gap here, gets filled. Name got pretty smoked, down 20% from, pre-earnings. And now it's starting to, find a buyer down here at support. So super wide range here. You don't need to be a hero and buy, the high day tomorrow versus the low. But this is one to definitely keep on the radar, see if it wants to trade back in this range. Big range here, 20% range. Just keeps it on the radar for potential support buyback. Next up, we have this ISRG. Again, healthcare names. Been pretty strong since end of September. They do have, this pretty big base they're trying to break. So if they do break it, name like ISRG could be one to keep a close eye on. Again, we can see same, resistance area at this 550. Big gap up on earnings, massive gap up on earnings, and sells off on earnings on the gap up, Next day, buyers buy right back. So we can see the buyers kind of holding this name up here in this 30-point range. Again, wouldn't be super eager to like buy this tomorrow through 550 versus, 525, but give this name a couple more weeks to really tighten up. And if financial or healthcare can get a push through their base, expect this one to go as well. Next, we have EXPE earnings coming up on Thursday and keeping a close eye on a potential opening range breakout through this 230. So if they report good earnings, they're gapping up but not through 230, and we can buy through that, could be, a good trade on our hands. Next up, we have this BWA, nice earnings, nice flag forming through 45. Again, earnings out of the way. Name gap down, got bought right back up. Again, still pretty big range here, 10% range. So keeping this one on the radar. Again, reported 3 days ago. We talked in the last chart talk or two about, when these names report earnings and there is a big move. Again, this is just, gap down, got filled, the upside, but give it a couple weeks. It's not going to go tomorrow. It's not going to go the next day. Let the name sit up for a couple of weeks and then be ready for that breakout and for that next move higher. So Raheem was looking at this WMB. Again, earnings out of the way. Again, earning miss, name is up. Again, earnings we don't care about. It's whatever their guidance is going to be. Their guidance is probably better than what their earnings was. And we can see very clear resistance at this 60. So tries to get above it, keeps trying to get above it. It's always battling with this 60 all of 2025. And each time it tries to get through it, pushes a little bit higher. So we're seeing clear resistance. We're seeing when the buyers can push through, they do push a little bit higher. And we're seeing them support this 56, which early in the year they weren't doing. So buyers are stepping up, sellers are still here. So keep an eye on this 60 base break. And if it does break this 60, be thinking of a move much higher than these prior highs. Thinking if you're buying 60, think 70. Again, it's going to take some time to get there, but that's the thinking. It's not let's buy 60 and sell 65. It's let's buy 60 and hold for new all-time highs. Lastly, for individual names, we have Block XYZ. Again, I wish they would have just kept the original ticker. I don't get why these companies change your tickers, just like Facebook did with Meta. Like just stick with what's what we all know, but is what it is. XYZ, very technical bull flag here. Again, you have the run up, you have the consolidation, very clear sellers at 82, very clear buyers at 72. So you got earnings coming up on Thursday. If there is any gap up, maybe there's a potential opening range breakout to gap up and push through 82. That would be the ideal scenario. Would not want to be buying this above 82. You want to, buy it through that break if given the opportunity. So again, we switched up this week. We started with the stocks. Now we're going to switch over to the major indexes and some key sectors, and then we'll be done here. So again, we've been talking about these key ranges the indexes have been in. Again, traders hate simple, but sometimes, simple is best here. Since May, this resistance level has been resistance. This support area has been support. Now, as this gets more obvious, it increases the likelihood of it eventually failing. So you have to keep that in the back of your mind. But resistance has been resistance. Doji at highs, we're at all-time highs, names gapping up, but it's selling off each day. It's telling you smart money is taking profits. They're not super eager up here to be buying, and support isn't that far off. This is 30 points lower, couple percent, not a big deal. But until this trend line breaks, trend's our friend, market's going higher. And really until we see a break of 590, the path of least resistance is higher. You just don't want to be chasing when things are extended and then being afraid to add when things look weak. So for ping-ponging back and forth in this range until that breaks, selling up here is wise, buying back here is where you make the money. Same thing with the S&P. Again, we're starting to see all the talk about S&P 7,000 or 700 and the SPY. Again, they're just big whole numbers. We got the back-to-back rate cut last week. The last 21 out of 21 times this has occurred, the market has been higher a year later. So we got that phenomenal news, but it's not a, snap your fingers, market's going to rally just because there's back-to-back rate cuts. So it does take some time for that news to digest and for equity prices to rise. So you can't just blindly buy things or buy the index hoping that, because this stat means you're going to get the best buy. So we're in this very key channel. 650 is the key out. So as long as we stay above this area right here, everything above that is just normal price action. Market can easily come back to 660 and bounce right back up. We just don't want to see this break of 650. We want to just stay above that. Just like in the Qs, Doji's at resistance, gapping up and selling off. Smart money is taking profits up here. And again, it's such a tiny pullback, but this is where we want to see. Again, all FAANG reported last week, kind of a mixed bag on their earnings, no dramatic, gap up, nothing that you're dying to chase. Meta and Netflix are pretty much big avoids in that space. So you have the biggest names that were reported have already gapped up and are fading that marginally or just outright avoids. The biggest names, in the market are not breaking out and they're going to start to pull back in. It's going to put pressure on the indexes, and you have individual names that are much smaller in the index, also kind of choppy. All the reason for letting the market pull in a little bit. So we're talking about the SPY 7,000 resistance level or artificial resistance. It's purely just a whole number, and people like whole numbers. But we saw the same thing with gold. Gold, no one cared about gold pretty much all year when it was flagging at 3,000 an ounce, but everyone cared about it at 4,000. So for sure, we could expect another flag to form, just like we saw 3,000 an ounce flagged for many, many months. We can easily expect another flag to start to form under 4,000 an ounce, but don't expect to see anything north of 4,000 an ounce anytime soon. This is going to be resistance. It's going to need to retest. It's going to need to flag out, just like it did here. No difference. So gold is definitely an avoid, but just the example of these big whole numbers, 4,000 an ounce magically becomes resistance and will be for some time. So definitely could see that happening with the S&P where it's just a big number. You're already starting to see articles hyping up that 7,000 area as resistance. So it's going to start coming in the back of people's minds of, oh, that's going to be the top. It can't go higher, but definitely could be an area of resistance in the short term. So you need to keep an eye on that. Again, the only kind of boogeyman really in the market, you got this dollar that's been basing. Again, weak dollar is good for stocks. So like this dollar selling off, great for the market. Dollar breaking out, not good for the market. Dollar basing, it's kind of a coin flip. But when you see these big bases after pull-ins, typically you see it push higher. So this could be something that, S&P gets to 7,000, dollar starts to break out, the writing's on the wall of that potential reason of why the market could pull in. Again, these aren't going to be dramatic market crashing drops, but we have to just know the ranges that we're in, and we don't want to chase at the wrong time or avoid the buys at the wrong time. So again, put to call ratio, normal, VIX, normal, nothing really out of the ordinary there. And wrapping up, we're going to go over some sectors. Again, semis kind of in their own league right now. We can see this resistance area going back many, many years, going back to 2020. And semis have kind of defied the laws of gravity and they're pushing above it for now. So we'll see how much longer they can stay above it, if they can really push higher and really just negate that resistance area. But the major indexes, most major names have been respecting these ranges. Again, the semi sector just really getting propped up right now. And for those in it, keep riding it. Strongest sector, until you see a break of this area right here, all's good in the semi space. This is going to be, if this is the high and we start to H back over with some lower highs, this is going to be when the party is over in the short term. So nothing yet, but you just want to know where these outs are. So when you see it in down the road, it's not a big shock and you know how to act accordingly. So healthcare basing out, you need to give it some time. Biotech super strong. Again, visually, just showing breakdown stage, basing stage, breakout stage. So we can see this breakdown took, about a year. We're about, 6, 7 months into this rally, or I guess I say 10 months into this rally off lows. So expect this climb back to highs like we saw from highs back to lows. So we're seeing, a lot of times you can see names, you almost think of it like a mirror. And what I mean by that is you were looking at a mirror, left side of the chart looks identical to the right. Again, history kind of repeats itself. Biotechs were big avoids. Now they're amazing. But you can see same basing action, same breakdown, almost identical run up. So we sit a lot with names when you can recognize these patterns. So biotechs, no reason to sell. Wait for that retest. Again, might take 3, 4 months to get up there, but should expect to see biotechs kind of ping pong back and forth and work their way back to these highs. Tech, just like the Qs, kind of same story here. Resistance and support in this channel has just been the same. Very simple lines here. Resistance is resistance, support, support. Selling up here has worked all of May. Buying into support has also paid off very well. So at the upper end of resistance, this is the time to raise stops and be a little bit more defensive. This isn't the time to be chasing tech names at the upper end area of their channels. Industrials flagging out very nicely. It looks great. Consumer discretionaries also, again, all-time highs, retests, people that were buying, this whole time and way down, can't wait to sell the retest, creates resistance. This is all it can pull back. Last time it was at all-time highs, dropped 120 points. Gets back to highs, drops 20 points. It's telling you buyers are stepping up. Even today, you know, right at the breakout level. So consumer discretionaries, right at all-time highs, right at a key breakout level. Definitely a sector to keep a very close eye on. Tesla is one of those names in that sector. Tesla at all-time highs, consumer discretionaries at all-time highs. This is the sector you want to keep focus on. Again, it seems very expensive. It seems like it's too high, but all these examples we showed before, when they get back up to highs third or fourth time, that path of least resistance typically is higher. So moving on, again, these, key point, consumer discretionaries is the focus sector-wise. Telecom, we're seeing lower highs forming. That is something to avoid. Again, we're talking about semis that kind of broke that resistance area. If we see a lower high form, like this arrow, and then it gets back down to that key support area, that's when you know the trade's over. The party's over in the short term. Again, telecom, insane run from the March lows, huge run, no real selling the whole way up. Now we're starting to see some distribution. We're starting to see a topping pattern form. So we're seeing the first two signs. The confirmation of that is going to be this break of that low there. So keep that on the radar. Again, REITs shook me out today, is what it is. I'll take that 1% loss. Again, looks kind of like a little bit like a bear flag. So hope it breaks out, but not in it from a swing trading standpoint. Again, mid and small caps still just kind of flagging out here under this big base. Small caps trying to push above their all-time highs. It's going back many, many years now. And energy names just kind of flagging out under this macro resistance area, just kind of off the radar. Again, some weak sectors, ones to avoid, utilities, which was the flight to safety. That flight to safety trade is now over. So again, avoid utilities, consumer staples. Again, this is when we were buying them a few weeks ago and they caught that nice bounce. It looked great. And like we had that bud trade, we bought that bud through that base break, just like consumer staples. We got that little pop, but didn't have the juice to get back to highs. So we had confirmed lower highs, confirmed lower high, and it sells off since then. So now the key area is this macro support. Let me get rid of these lines here. This has been macro support, and consumer staples are simply just an avoid until we test the support area. So when we test this area, it pulls in a little bit more, probably has to shake out 200. Then we can go back to those consumer staples, look back at those Walmart names, and take that trade just like here. Looks horrible into support, and then off to the races. So needs to get a little more ugly before it's going to get, pretty again. So expect that break at 200. Look back at them. Materials, massive avoid. Again, I haven't changed these lines for about a month now. Just, H and over to new lows, or not new lows, but recent lows. So materials, big avoid. Nothing here screaming to buy. Let it keep breaking down. And financials, very clear breakdown stage. Seeing the start of another breakdown stage. So avoid utilities, avoid consumer staples, avoid materials, avoid financials. The big focus right now really is consumer discretionaries. Again, tech has been strong, semi has been very strong, but they're very extended in their relative ranges, semis and tech, where it's hard to press it here, where consumer discretionaries are kind of just getting started, with very tight defined risk. So big focus week ahead is consumer discretionaries. Hope you guys found this week's chart talk helpful. If you have any questions, just drop them in the comments below, and I'll see you guys in the chat.